Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be taking a look at Autonation stock, ticker AN. This one came in by request down in the comments section of one of my other videos. If you have a request of a stock you'd like me to analyze on the channel, just put it down in the comments. I'll get it on the whiteboard behind me. I actually have a pretty decent sized list still up there. And eventually I'll make a video. If it's a stock that's in the S&P 500, usually I post those on YouTube for free. And if it's not in the S&P 500, I will still make a video, but I post those over on Patreon. There is a free tier member there now, but the $5 tier will get you any requests of stocks you'd like me to analyze that are not in the S&P 500. And as long as they use strategies, the three main strategies that I publicly share here on the channel. If they don't, then usually I still will talk about the stock quite a bit, but I might not share my specific strategy that I'm using in the full Cyclical Investors Club service over on Seeking Alpha. But if you do join Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service. So head over there and check that out. I'm also, over the next several months, I'm going to be doing a lot more with the free tier section over on Patreon. So it'll be worth checking that out. As always, this is not individual investing advice. This is just how I analyze stocks. I'm going to want fast graphs here for a good part of this. I do have a 25% off affiliate link down in the description if you want to try it out, if you haven't already done so. Okay, let's get into this. So Autonation, this one's pretty interesting. I wanted to think about it a little bit before I made my video because I don't want to be too negative and alarmist, like I'm predicting a crash, but I would say because there's a chance that it might not be really bad, but the risk is pretty high of a very deep down cycle / bust from the pandemic stimulus. And if you look at the fast graph, you can immediately kind of see what I'm talking about. So this dark green shaded area are earnings per share. And you can see that they were chucking along pretty good here. The basic rate from here, from like 2004 to 2019, was about in between 8 and 9% earnings growth rate. That doesn't include this dip that occurred during the Great Recession. So maybe slightly on the optimistic side. But again, we have more inflation now than we had then. So probably in the future, that'll make up for the dip that they had in earnings here if things normalize, right? So we go from, well, let's just call it 8-point-something% growth, earnings growth, to, if I shrink this down, 50%, then 150%, and then 35%. So let's call this like 250% earnings growth in 3 years. So they probably had more earnings growth in 3 years than they had in the previous 15 years or something like that, or at least 10. I mean, we can go back. I think it was maybe $1.50 at some point back there. Yeah, so let's just say $1.50 to $4.50, so that's a triple, so a lot of earnings growth packed into this short time period. And now we do see the signs of, now I've had this stock flagged, I do track it as a potential boom bust stock, which means there was this stimulus boom and other factors, COVID factors and things like that, people moving to the suburbs and needing cars and supply chains and on and on and on. But at any rate, this profit boom was likely going to have a bust. Now that has started, but it hasn't really fully materialized. Now, from the time that I updated this last in January, my spreadsheet, to today when I went to refresh everything for this video, earnings expectations had already fallen more. This was over $20 per share just 3 months ago, and now it's under $19 per share. So these expectations of this year's earnings are rapidly coming down. I expect they'll be, over the next couple years, probably much lower because of interest rates, because a lot of people that wanted new cars pulled them forward. They borrowed money for them. The cars are depreciating relatively quickly now that were bought during that time period because people paid too much money for them, because dealers could charge that much, and so they did, and that's where all these profits came from. So there's all that going on, and I would expect that if interest rates stay where they are, I mean, we've had like 20% plus inflation during this time, so let's call it 30% inflation since here. So maybe you're looking at $6 to $9 per share would be normal. So that's an additional 50+% drop I would expect in earnings, just if interest rates just stay right where they are now. So yeah, and that might not happen in 1 year. It might take 2 years, but that would be my base case like expectation. And definitely the risk of buying the stock at these levels. Now, one thing and that's why when you look at a 7 PE, it looks attractive. Well, it doesn't look attractive if earnings are 60% lower, right? So then that immediately goes up to like a 16 PE, which is just average. Okay, it might be a little better than some of the things in the market but those are steadier earners. Additionally, these guys do have like some debt, so they could have a little bit of exposure there to interest rates as time goes on as well. I don't know exactly. I mean, I haven't dug super into like their business in terms of like the structure of the business and everything, but it wouldn't surprise me if they finance their inventory. So if they aren't moving through inventory fast enough, that could be a steady rising cost for them over time if interest rates stay where they are. And then financing on their customers. So I did look at their annual report for last year, and I didn't go back in time to see how reflective this was of like a normal year. So I didn't do that much deep research, but I just wanted to kind of see where they're making their profits, because that can kind of play into this a little bit too when we're thinking about it. So their biggest profit source is actually parts and service, which is about 40%. So these are gross profits that I was looking at. Now that is probably good for them because there's a lot of because we haven't had that much car inventory the past couple years, especially at least in the US. People are driving older and older cars, and they're financing for longer and longer. That means you pay for repairs more because your cars are older, just generally speaking. There's better quality cars, but there's still a lot of maintenance that needs to happen if you have an older car. So that's why stocks like AutoZone, O'Reilly have done really well. I own AutoZone, and I decided to hang on to it even though I think it's up like 300%, partly because of this effect that we're having. People, when they get in a pinch or they just want to save money, they'll do the work themselves. We have YouTube now, so you can sort of make money in a different way by people driving these older cars. So parts and service is one of those. 30% from financing, that could be a risk. Financing and insurance and all the other crap they sell you when you go to buy a car. Now, I'm sure they have like third-party financiers, but it looked like they did have an arm of their own financing. Again, I didn't dig super deep into it. This could become an issue if there are more defaults, and there definitely are more defaults. They are going up. I wouldn't say they're really high yet, but the trend is up. And I think that's one of the reasons why the Federal Reserve is getting kind of nervous here, because I'm going to talk more about this in the future, but I think defaults are what they're worried about. The other things that they're talking about don't really matter. They're bankers and they lend money. And when people default, they don't get their money back. So if they need to lower interest rates in order to stop the defaults or lower them to a reasonable level, then that's what will be the main thing to cause them to lower interest rates. So businesses like Autonation are actually kind of the people that they are having in mind when they're considering whether to lower rates. That's why they want to lower rates, but since inflation is still high, they haven't been able to fully justify it yet without giving away the fact that they really care about defaults and not unemployment or whatever. But that's a totally different story, even though it's important to kind of have that context. So 70% of what these guys are doing isn't directly related to profits on cars. So 20% comes from new cars, 10% from used cars. And sales of cars, I think, have slowed quite a bit. And I think, especially at the dealer level, and you're going to see that bleed through, I think, to the manufacturers. It's happening now, probably. We see it with Tesla. I think Tesla's is, I'll get a little off topic, but on topic still. Tesla has like these direct, like they don't have dealers, right? So I think we're getting a faster read on what's happening in the car market from Tesla than anywhere else. And I don't think it necessarily has to do with just the electric cars, because like the manufacturers sell the cars to the dealers first, and then the dealers have to sell them to make their profit. So the last person that kind of is going to feel it are going to be the manufacturers, because the dealers were so low on inventory, they kept buying from the manufacturers for, let's just say, an extra year. And now it's getting to the point where probably the dealers aren't turning over these cars as fast as they need to, and so they're not going to buy as much from the manufacturers. And so now we'll probably start to see it with a delay, where I've already seen it with Tesla. We'll see it probably with a delay with these other car manufacturers, I think. If interest rates, a lot of this is dependent on interest rates, if they stay where they are. So the question is, if interest rates come down, that could put a bottom at some point under this down cycle, if they don't wait too long and there's like a real fuller, wider recession. So that's the balancing act here. I'm not the one that really tries to pick the tops of cycles or get the top 25%. I aim for buying close to the bottom with the expectation of a recovery. So that's the approach that I would take with Autonation. Now, historically, their earnings haven't really been super cyclical. That probably has to do with the mix of their business that I was just talking about. So they're not just a manufacturer that's just selling cars. They're making money off parts and service. They're making money off financing arrangements and things like that. So 50% decline in earnings is usually the threshold I use for a deep cyclical. Theirs fell 36% during the Great Recession. And it bounced back within a couple years. So that's pretty good. However, the price got totally slammed. Now, I also will point out, this is an important point. This is using the adjusted earnings, which are put out by the company. If you look at their basic earnings, they lost a bleep ton of money in 2008. So this might be a more honest representation of what actually happened. But usually when I'm classifying stocks, I just use the adjusted earnings because I go through a lot of stocks. And I kind of, over the long period of time, I just kind of give the management the benefit of the doubt. They're counting everything right, because I'm not digging into all this until I maybe get closer to buying something. So I would consider this probably a deep cyclical, especially in the event of a recession. So let's get into the valuation real quick. I'm trying to not make this be a really long video, but this is kind of complicated. And I have to talk a little bit more about their business than normally I would, because it's so weird with the boom bust from the pandemic, right? So if we do a basic analysis, you can watch some of my other videos if you want me to take you step by step through this. I'm not going to do it right now. I do control for their debt, so I'll show you how I do that really quick. So I look at the difference between the total enterprise value and the market cap, and whatever percentage this is above the market cap, which represents kind of these other obligations, like debt, I adjust the stock price by that much. So this is about 74% higher. So when I run this valuation, I treat the stock price like it's actually $267 per share instead of $150. So that might be a big adjustment that other people might not make. So we do that, and I just run my basic analysis. We have a 10-year CAGR of 7.8%. So 8% is the threshold above which I would consider something a buy. So, and this assumes that 8.15% earnings growth rate, which is what it was before the pandemic. Okay, it's actually, like I said, I didn't count the Great Recession drawdown when I put this in. This just came straight from fast graphs. So, if we assume 8% earnings growth on their earnings, this earnings $18.97 a share this year, then it would be pretty close to a buy, actually. Like 148.50 is what it would come out to. The problem is, as I pointed out in the past 3 months, this has fallen over $1 already. This is probably going to keep falling until we get to the point where, it starts looking more expensive and more expensive because the earnings is falling. So in order to counter all this stuff, I created a thing called the recession PE. So it's designed exactly for stocks like this, where historically, where you have the price falls a lot more than the adjusted earnings. So if we go back to the Great Recession, adjusted earnings fell, 36%, but the price fell more like 80, right? So there's a huge disconnect between the two, probably because the basic earnings were actually much deeper. But I can determine all this without digging in like too deep. I can say, okay, the market is treating this like it was way worse than like a 30% like recession decline or whatever. So I know that ahead of time. And so what I do in this situation is I take the low price, which was $3.97. I take the high earnings, which was $1.54, and I create what was this PE ratio. Like this is the most pessimistic PE ratio basically that you could create, but it remains stable because these peak earnings will remain stable during a recession or a bust like we're experiencing right now. So I have that recession PE. It was like 2 something. I'll show it. Like it was really low. Yeah, I'll show it to you in a second. But we take that same principle. See, while this earnings number is going to continue to probably drop, their peak earnings will remain the same. It'll always be $24.57. So wherever this price comes down relative to this peak price or this peak earnings, I can use that as a steady measurement of how cheap it is relative to what it did during the last recession. All right. I know this is complicated, but sometimes you just have to be complicated. All right. So I take that old 2008 recession PE, which was 2.59 recession PE. I add 40% to it, which is what the 1.4 here is. And that, because I'm not trying to pick the worst scenario. I just want to get closer to the bottom so I can maybe get better returns, right? So this is actually 40% above that, which is a recession PE ratio of 3.63. That's what I'm aiming for. So we need to fall 66% more to 51.20 in order to get down to that price. Now, once we get into a situation where I don't think this recession or bust risk from the pandemic stimulus and supply chain and all that, once I think that's over, I'll just remove this recession PE factor and I'll just go back to like the normal one. But I definitely don't think we're in that situation yet. Maybe if interest rates get lowered, but even then I might not be like totally convinced. It might just kind of spread out what's going on, which means the stock price might not fall as much. I might not get an opportunity to buy it, but that's just how it is. Now, if a person is able to buy you don't have to get too many of these, to do really well. So I'm not going to pick the absolute bottom this time. I'm just going to, let's just go, this had risen quite a bit. We'll go January 2009 to before the thing. So yeah, so even you're not even like at the exact bottom, you could still get an 18% CAGR for a decade, if you're just buying down there near that low price somewhere. And that actually wasn't where it peaked. It actually peaked quite a bit before that. So I'm not going to pick the exact same spot again probably, but yeah, up here it looks like it was even better. So you could have got a 30% CAGR for the first 5 years out of there. So it's worth. And of course, if you're not aiming for returns that high and you're willing to sit through a big drawdown, if you buy too early or pay too much, you can pay more for it. But my thing is, I want to try to buy when it's close to the bottom. And hopefully I get enough opportunities, because watching enough of these type of stocks where I can get opportunity. So yeah, I would say I definitely think it's risky here, because I don't think those earnings are going to hold over the next year or two without a recession. So that's where I'm at on this one. Hopefully those numbers helped everybody. Context helped a little bit. It's a tricky one. And if you have a request, put it in the comments section and I will make a video for you. All right, if you found this useful, hit the subscribe button, hit the like button. I'll see everybody later. Bye.